Great. Well, thank you very much, Yongheng. I was thinking before the talk today. I was trying to count up the number of times I've been to Singapore, and I think it's 10 or 12 times now, and over the past 15 years or so. And it's really been wonderful to see how NUS and NUS real estate has gone from merely great to really great in everything they do, as well as to see how Singapore as a city has done exactly the same thing, gone from really great to just a model city that everybody pays attention to from all over the world. It really is one of the great cities in the world, and it's always a pleasure to come back. I'm going to talk to you about REITs today, and I'm going to primarily talk to you about U.S. REITs, which I know them much better than I know REITs in most other countries. REITs have been a tremendous success story in the United States, and I'm going to talk about a few reasons why they have been very successful. And then I'm going to suggest that REITs as an owner and an operator of commercial real estate, it's a model that we should think about exporting around the world more. REITs have done great things for real estate in terms of being an allocator of capital, relieving some of the stresses on the banking system, and reducing boom and bust in real estate markets. Certainly that's been the story in the United States, and to the extent that we can take that and export it to the rest of the world and do more of the same in the United States, that would be a very good thing. So why don't we get started? I'm going to start with a quote from Ed Glazer, who's a Harvard economist who's visited Singapore. And the quote is, "Singapore is a city innovating under constraint. You have a limited amount of land. You have to make sure you're not wasting it." I think everybody would agree with that statement. And I would only add that, and implicit in the statement is it's not only the land, but it's what you put on it. And the thing that I want to focus on today is it's not only that, but it's who owns and operates it. Okay, that's really the theme of the talk today in the context of REITs. But first, let's talk about who owns real estate around the world. But first, before I show you some numbers, there are basically three categories of owners. There's traditional investors in real estate. And that's up until probably the last 30 years or so. Anywhere in the world you looked, the owners of real estate were the traditional private owners, individuals, families, moguls. And then starting in the 1970s, institutions started taking positions, I think first primarily in the United States. Singapore was a leader with the Sovereign Wealth Fund. Institutions started buying commercial real estate. And when we say institutional, we mean primarily private and public pension funds, endowments and foundations, insurance companies, and sovereign wealth funds. And then finally, although REITs have been around in the United States since 1960, I believe they've been in Singapore now since 2002. Other countries adopted them somewhere in between, some after 2002. But really, REITs have only really mattered, have gained critical mass since the mid-1990s. Before the mid-1990s, there were very, very small players in the United States. So REITs are a very recent phenomenon. But when you look around now, they really own quite a bit of real estate, and they own more and more real estate every year, as does institutional investors. So what are the numbers? The numbers are a little bit startling. These are very recent calculations. I got these numbers from LaSalle Investment Management, and they've been working on putting together these numbers for a number of years now. And maybe working from the grade level over, there's close to estimated there's close to $50 trillion of investable commercial real estate worldwide in U.S. dollars. That's a lot more than I had estimated. I remember I was trying to estimate, and I pulled this together for this talk. I hadn't done this exercise for quite some time. Maybe 10, 15 years ago, I tried to estimate investable commercial real estate in the United States, and at the time I remember my numbers were something like $4 to $6 trillion. $4 to $6 trillion in the United States, investable commercial real estate. And that would have probably put the world investable real estate at around 20 trillion. It's grown a lot in the last 10 or 15 years, $50 trillion. And most of that is privately held because the other two categories are institutional. That's $9 trillion. Those are the pension funds, sovereign wealth, etc. And then public real estate, those are REITs and other publicly traded companies. That's about $3.6 trillion. So when you subtract off the 12.6 that's estimated for institutional and publicly traded, we still have about 37 trillion. A vast majority of real estate is still privately held. But these other two bubbles are getting bigger all the time. In terms of what the U.S. is still the biggest player in terms of probably each of these categories, but the percentages vary. In public real estate, I would say that 40 to 50% estimated is the U.S. ownership share. So they're really by far the biggest players in terms of the REIT market. Institutionally, they're probably 30 to 40% is U.S. real estate, U.S. located real estate. I'll show you some numbers in just a moment. And then that would leave, once you do those calculations, that would leave about 25 to 30% of all real estate being in the U.S. In any case, big numbers. How does this compare to other markets? On the, let's see if I can get the pointer. This is total commercial real estate, right around the $50 trillion mark. This is the estimated global equity market, a little over $50 trillion. So commercial real estate is almost as big worldwide as the stock markets are, equity markets are worldwide, approximately the same size. And then on the debt market side, this is financial, this is private debt, and this is government debt. So each of these pieces are approximately $50 trillion as well. So commercial real estate is about the same size as equities, privately held, privately issued debt, and government debt. When you add these four up, you get about $200 trillion. In other words, based on these numbers, commercial real estate is between 20 and 25% of the market portfolio. Right? If we want to call this investable, 20 to 25% of the market portfolio. Now, we're probably missing some stuff here, some other investable stuff, and maybe the other forms of private equity. And I would just ballpark it, I would say there's probably another $50 trillion of that other stuff that's out there, just to keep our numbers nice and even. So when you add, if that's approximately right, if you add that in, then it looks like, in terms of the market portfolio, that commercial real estate is somewhere between 15 and 20% of the market, something like that. So if you want to own the market portfolio, right? One of the basic things you learn in finance classes is if you want to be a diversified investor, you want to be along the capital market line. And that means that you own some percentage of the market portfolio and the riskless asset. And that means that if you want to be well diversified, you want to have commercial real estate should be 15 to 20% of your portfolio, right? Those are substantial numbers, big, surprisingly large. Here's where we are in terms of, here's a time series going back from, whoops, what did I do? Going back to 2001, in terms of shares basically by continent. The Americas are the purple, that's and that's mostly the United States. Canada is the next biggest piece. Asia Pacific, Australia, New Zealand, Europe, and Middle East and Africa. And you can see that if you go back before the financial crisis, what's happening is that, it's probably not surprising, is Europe is, but this is just commercial real estate, Europe is losing market share. And the United States, or the Americas, primarily the United States, are holding steady. And Asia's gaining market share. And if you look at the difference here, Europe going from 41 to 28, losing 13% of the market, that 13% basically has gone to Asia, right? So there's just been a shift from Europe to Asia in terms of the estimated investable real estate that's out there. And then if you go, and this is 2015 when these numbers are estimated, so we're up here at about close to $50 trillion. And by 2020, the LaSalle Group estimates that we'll be up to a little bit in excess of $60 trillion of commercial real estate that's investable, with again Asia gaining our market share. It's also interesting to look at cities, right? So where is the investable real estate located? And again, it may not be surprising, but it's very concentrated. The 20 largest global cities account for 40% of the market. Okay, 20 largest cities account for 40% of the market. That's a lot of concentration, and there's a lot of population concentrated in those top 20 markets. And so it's probably not surprising that it's there, but that has some implications, I think, in terms of investment. And what we have here are two columns. One is this is the estimated institutional investment by market, by city, and this is total commercial real estate. We can see here's Singapore is number 9 on the list on the institutional side, and number 7 on the list in terms of total. If we look, Tokyo in terms of value is number 1, right? So the amount of land is small, but the value of that land is extremely high. New York and London are 2, 3, Hong Kong's 4. The ordering here is not terribly surprising. If you count the cities, we've got 4 cities. 4 out of the top 10 cities here are Asia. And 4 out of the top 10 cities are U.S., and then we've got 2 in Europe, Paris and London. And you can see over here in terms of these percentages, this is the top 10. This adds up to these global shares, and on the institutional side add up to 27%. So the top 10 cities, approximately 27% is concentrated of the investable institutional real estate is concentrated in the top 10 cities. Interesting. A little bit more on institutional. Now, today I'm going to talk to you mostly about REITs, but I am also going to talk about institutional investment. Highlight, and I've got some concerns there on that side and highlight it. So I wanted to lay a foundation with some numbers here on the institutional side. So this is institutional commercial real estate allocation. What percentage of the institutional investment portfolio is allocated to real estate versus basically equities and fixed income, and some other stuff to private equity and other investments. And again, I only pulled these numbers together for this talk. It's been a while since I've looked at the numbers, and I was surprised that we're up close to institutional investment is up close to 10% of the portfolio. Probably the last time I gave a talk along these lines was 10 years ago. And 10 years ago, before the financial crisis, 2005 or 6, the institutional portfolio was only 3 or 4% real estate. It's basically tripled in the last 10 plus years in terms of the allocation to real estate. Right? That's a big difference. 10 years ago, I was arguing that institutional investors needed to allocate more money to commercial real estate. Today, by the end of the talk, I'm going to argue that maybe not. Maybe it's time to pay attention to these allocations, and maybe we are at a point on the institutional side where we might start wanting to say that enough's enough on the real estate. But even at 10%, right? So this is where we are today, estimated even 10%. And we're probably missing some here. I think that there's other real estate investment by institutional investors that isn't getting counted here in terms of money that's allocated in their opportunistic buckets. Where that money is going into private equity firms as equity money, and those private equity firms play in real estate. So this number might be, say, 12%, roughly speaking. That is still less than the percentage that I talked about here in terms of the market portfolio, right? I just argued that commercial real estate, even if we add in another bucket over here of private equity and other stuff, commercial real estate is probably 15 to 20% of the market portfolio. If that's true, then there's still maybe some room to run On the institutional side, maybe you could make the opposite argument that institutional investors, there's still more room for real estate in their portfolio if they want to mirror the market. This is just a breakout of institutional in terms of this is public pension funds, private pension funds, sovereign wealth, etc. And you basically see, most are around the 10%, a little under the 10% mark. Private pension funds are a little bit less. But again, the shocking thing to me is 3 times, the allocations are 3 times what they were 10 years ago. A lot of money globally, right? Pension funds sit on huge amounts of money. Pension funds and other institutional investors, huge amounts of money, trillions of dollars, have moved into commercial real estate as investments. And what this shows, this has the title dry powder. This is the amount, basically an estimate of the amount of money that's sitting on the sidelines now looking to be invested in commercial real estate. So this is funds, these are funds like BlackRock and others that have raised money for dedicated investment in commercial real estate, and the money is still sitting there. It hasn't been allocated out yet. But the thing to notice about this is that the trend is growing quite a bit, right? There's a lot of money, as we sit here today, there's a lot of money chasing commercial real estate through institutions, by institutions through funds. Okay, now let me say one more thing about institutional investment, and then I'm going to move on and start talking about REITs. So more and more commercial real estate is being held by institutions. Is this a concern? And my answer is at least somewhat. At least for pension funds, some endowments and foundations. And for real estate, they primarily hold real estate through funds. They invest directly through open and closed-end funds that are offered by entities such as BlackRock and the like. Why is this a concern? It's a concern to me because pension funds in particular, but some of these other players, sovereign wealth less so, but I don't understand very much about sovereign wealth. That's sort of, there's a lot we can still learn about what the objectives are of sovereign wealth funds and what they actually invest in and what they do. But certainly pension funds, we know this is true in the United States, it's true in other parts of the world, but it's especially true, I think, in the United States, that many pension funds are underfunded. And endowments and foundations are under similar sorts of pressure to generate high returns in a very, very low interest rate environment. And we're basically at 0 rates many places in the world. So what's happening is we've got incentives being underfunded and being in an environment where there are extremely low returns to many kinds of investments. There's a lot of reaching for yield. It's particularly the case with pension funds. And you need to be very beware of the desperate. So there's an era of desperation. One needs to be fairly aware of desperate investment, because at the end of the day, there are incentives to take excessive risks, and ultimately what happens then is resources can get misallocated, and as a result, I would argue that at least in the United States, the biggest risk for the next financial crisis, it might not be systemic, but the biggest risk for the next big crisis is it could originate from the pension fund world. For these very reasons, the reaching for yield, which may cause financial instability and some political disruption, because it'll create problems with retirees who no longer have the retirement that they thought they had. Okay, so is there a better way? So I'm expressing some concern about some channeling this capital into commercial real estate through institutional investment. It's not going to stop. It's something we should probably pay more attention to. But is there a better way to channel the capital? And I'm going to argue yes. I'm going to argue that REITs have been extremely good stewards of capital, at least in the U.S. The U.S.-style REITs have been very good stewards of capital over the last 10, 15, even 20 years. They haven't done everything perfect, that's for sure. There's been some ups and downs in the market. But overall, the experience has been quite good. And they've generated some real positive externalities for society. They've reduced systemic risk. banking risk in the United States, and they've reduced boom and bust. So I want to try to convince you of that and show you some evidence here today, and argue. And Singaporean REITs, which I know much less about, have also been a tremendous success story. Singapore REITs do things a little bit differently than U.S. REITs. I think we'll probably talk about that some when we have our panel discussion. But let me talk about the U.S. REIT experience as at least a model or something to be held up that we might want to consider exporting to other parts of the world. Not necessarily Singapore, but maybe other parts of the world. Singapore's done just fine. So, okay, why REITs? I'm going to talk about three things. First, I want to talk about capital allocation. It's pretty simple in terms of these are publicly traded firms, listed share prices, and it's a simple story, which is that when share prices are high, that implies that the cost of capital, equity cost of capital, is low, and that's a signal, that's a green light to buy assets. Right? You've got a low cost of capital, maybe low relative to your competitors, institutional investors and private investors. Go out there and buy assets. On the other hand, when share prices are low, as they have, REIT share prices have actually been pretty low in the United States for the last year or so, year and a half. That's a red light signal. First of all, it means slow down in terms of your buying activity, and even something more than that, which is that if share prices are low enough, your cost of capital is high enough, your firm is worth more to the shareholders. The signal is that it's time to sell, right? Others will pay more for the real estate than your shareholders will at that moment in time. So you can do your shareholders right by actually shrinking the company. Now, do you think that's possible, right? So these are publicly traded firms. They're going concerns. They're in the business of getting bigger, not smaller. But that's the basic signal, right? That's what at least in theory efficient capital allocation should be about. In contrast, on the private side, private investors, at least in the U.S. and I think in certain other parts of the world, as long as debt is available, they'll invest, right? So if banks are willing to lend, they'll invest. It doesn't matter really what else is going on. And banks sometimes don't allocate capital, the debt capital, efficiently. So I would say private investors have a different set of objectives and things that they pay attention to than REITs. Institutional investment, it tends to be a little bit slow in response to market signals. It's hard for them to catch the bottom of the market, and they also oftentimes miss the top of the market. In between, they tend to do very well, but when the market turns quickly, that's when it's difficult for institutional investors to get things right. Whereas REITs with their share prices, right? They're traded every single day, every minute of every day that the market's open. You get continuous time price discovery that's giving you signals, and that's a very valuable thing. So let me show you some data on the capital allocation side. So this is again U.S. This is premium and discount to net asset value. So the net asset value is an estimate of what the real estate is worth, what the real estate value is for the firm. And is the firm trading at a premium or a discount to its real estate value? The zero is the break-even point. So when you're up here on the positive side, that's the green light, right? That's the signal is go, and the higher the premium is relative to NAV, that's a stronger green light. You've got a very low cost of capital. When you're down here in negative territory, which, like I just mentioned, this is 2015, and if you take this through 2016, this is continued. REITs have been in moderately negative territory, which is a red light, right? That's stop. And how does this line up with actual capital raised by REITs in capital markets for investment purposes? It actually lines up really, really well. So let's take over here. This is around 96, 97. This is green light territory. REITs are raising capital. Around 2000, late 90s, 2000. This is red light territory. Slows down. Early middle 2000s, green light territory, REITs are raising capital again. Here we hit the financial crisis, definitely red light territory, 2008 particularly, but there's this, there's sort of this dip here, capital raising declines. Then post-crisis, pretty quickly, after the first quarter of 2009, actually REIT share prices went positive relative to NAV. So it was a green light, and REITs, U.S. REITs raised a lot of capital, right? So this is a very good indicator to me that REITs are responding to market signals that they're getting in their share prices vis-a-vis premium and discounts to NAV. And I sat down 2 days ago and I ran a correlation by year between the premium or discount to NAV and the scaled market cap. So I looked at capital raised scaled by the total market cap, and the correlation is 0.78. That was it's very high. Strong relationship between REIT share prices being high or low and how they raise capital. I think even more impressive, this is a very recent report by a company called Green Street Advisors. They're an independent REIT analyst out of the United States. Very well respected. I teach an entire course on REITs at my university, and I also advise second-year MBA students who actually invest real money, $2 million in REITs. Okay, so they're investing real money in REITs, and both my students who take the class and those students who are investing the real money, they spend a lot of time reading these Green Street reports. They're very good reports. They do great analysis. And what this shows, so this is 2016 estimated. What they're showing here is on the horizontal axis, these are individual companies, right? So these are this is the company names, the listed names, the abbreviated. And what the horizontal axis is showing is the trailing 6-month unlevered asset value premium or discount. So that's like what I was doing before. So here's 0. So this territory over here, this is premium to unlevered asset NAV. This is discount. Okay, discount premium. And then the vertical axis is the growth in assets, right? The external growth, whether the company's expanding or shrinking on an annual basis, right? So are they investing, or are they doing nothing, or are they selling? And it's pretty striking that firms that are trading at a premium to NAV, that's the green light territory, they're up here in this quadrant, and they're investing, right? They're investing 5, 10, even close to 15%. They're growing year over year in terms of what they're buying relative to their asset base. On the other hand, firms that are trading at a discount to NAV, it's hard to believe, but they're actually selling assets, right? They're shrinking themselves. Exactly what the theory says that they should be doing, they're actually doing, right? I don't think you see this very often, and certainly not in the real estate world, unless you've got financial distress or unless there's something really bad going on. Real estate companies just don't shrink themselves voluntarily. These guys are doing it. These guys are doing it because they have a low share price. They're not financially distressed, right? They haven't busted covenants, debt covenants. Nobody's forcing them to do it. Management's responding, right? They're shrinking. These guys are actually shrinking 5 to 10%. EQR, that's Equity Residential. It's the largest REIT in the United States holding multifamily properties. Their market cap is something like $20 to $30 billion. Big company. They're consciously shrinking themselves, right? Some of these others, this is Pebblebrook, this is a hotel company. A lot of this is hotel, this is Host, the hotel company. A lot of hotel companies, a few multifamily, have been trading at significant discounts to NAV, and they're shrinking. Now, there's other companies that aren't doing the right thing. They're identifying over here. There are companies, right, that aren't paying attention. They are buying assets, they're growing, but they're doing it at a time when their share prices are low. And you can bet that these share prices their shareholders are going to vote negatively, sell their shares, and it's going to depress share prices even more, and they're not going to be able to do this kind of thing for long. Right? But if you try to draw a line here, a regression line to fit the dots, it's going to look something like this. And that's, again, pretty impressive. The line is doing exactly what you would expect it to do, at least what theory would say, which is that share price is high, firms are buying. Share price is low, firms are either doing basically doing nothing or they're selling. Individual companies. The guys over here who've been growing with the positives, this self-storage REITs in the United States have been on fire for the last 5 years. You know, it's basically just lockers where people keep their stuff, right? It's been one of the very best investments in real estate that you can find. Also very hot in the United States are REITs that own mobile homes, trailer parks, where people live in these houses, these very inexpensive houses. Not terribly sexy, not New York office buildings, right? New York office buildings, performance has been so-so. In the same report, Green Street did the same kind of thing. Again, premium or discount to NAV, whether they're selling or not selling by sector, right? And you can see hotels are trading at a discount to NAV. They've been selling assets. Multifamily, discount to NAV, selling assets. Net lease companies, manufactured housing, that's the trailer park companies, positive. They've been buying, self-storage has been buying, right? Again, if you draw a line, lines up very, very nicely, right? That's my capital allocation story. Very, very, very successful and powerful, I think, in terms of what the data tell you, in terms of what these publicly traded companies are doing. They're doing the right thing. Okay, number two, the second reason I like REITs is that they keep their leverage low. By now, we understand there's been a tremendous amount written in the last 7-8 years about the risks that real estate pose to the financial system. When you look around the world over the last 100 years, most financial crises, the vast majority of financial crises, have something to do with real estate, right? Banks making mortgage loans on real estate. And it causes all kinds of problems. The financial system blows up in countries, sometimes around the world, like what the United States triggered in 2008, and creates tremendous disruption. So leverage is an issue with respect to lending on all kinds of real estate, but in particular commercial. There's residential and there's commercial. We're talking about commercial, big risk. In the United States, for privately held real estate, the typical loan-to-value ratio on properties, and if you look across private companies firm-wide, the leverage ratios, LTV ratios, loan-to-value ratios, the debt leverage ratios are oftentimes in excess of 70%, fairly high leverage. REITs, on the other hand, have much lower leverage, and it's been getting lower. So what this is showing here, this is leverage on this axis, and the bars, I'm not going to talk too much about the line. This is debt to EBITDA, so it's a debt to income ratio. Let's look at the bars, and what's happening is that historically REITs were around 50% levered, which I've argued for a long time was too high for REITs. They have access to all kinds of other forms of capital, primarily equity capital through the capital markets, which is attractively priced at the right, when they should be buying, they can access their market. And then a number of REITs got hurt in the financial crisis, leverage levels spiked because share prices fell so much. But what's been happening since the financial crisis is that REITs have been delevered, and they're now down, on average, to about 35%. And that's a good number. That's 1/2 of what you see on the private side, typically. The private side is typically 70 to 80% levered. The average real estate company is 35% levered. Why is that a good thing? It's good for the banking system. There's less total leverage overall. There's less debt capital that's flowing to real estate. Moreover, 2/3 of the debt that's out there with these REITs is unsecured debt, not mortgage debt, right? Mortgage debt is the stuff that the banks hold or that is securitized. Unsecured debt is the stuff that comes through the capital markets where there's a bond rate, right? Again, that's outside the formal banking system, right? That's capital market debt. So if you take out the unsecured debt and just look at the mortgage debt that's out there, it's even less. It's only 10 to 20%, right? Low leverage, right? Low amounts of debt, banking debt that's going into these companies, and that's good overall for the financial system. I'm making this low leverage argument. Does it create value for the companies though? Does it make sense for these companies to be low levered? Well, what this shows, this is from some of my own research, and this is the market. This is a market to book ratio. So this is the market value of the company, debt and equity, divided by the book value of the assets. So it's sort of like a measure of premiums or discounts to NAV. The denominator, the thing that's underneath now, is book value of assets rather than an NAV estimate. But it's the same idea. And so that's what's here. This is market to book on the vertical axis, and on the horizontal axis, we're looking at leverage. These are REITs, year over year. So the same REIT is showing up, but this is 97, 98, 2007, 2008. The data here go from 1993 through 2015, I think. And what we see is that for low leverage, firms trade, it sort of peaks here at about 25 or 30% leverage. But at about 30% leverage, this is about the peak. Firms are trading at a 40% premium to their book value. Okay, that's share price. As we go from around 30% leverage, a 1.4 ratio, as we go to 60% leverage, it goes down to roughly 1.2, approximately. So we go from 1.4 to 1.2. It doesn't sound like a lot. It's big, right? That's 20% of the asset value associated with leverage, right? You lever up from 30% to 60% as a publicly traded company, you lose 20% of your value as a percentage of assets. If you take it as a percentage of your share price, these are levered companies, moderately levered companies. If you look at it as a percentage of the share price, it's something like 30% of the share price. So these companies all, and we've done regressions and tried to control for other things as well, and this relationship basically stays the same, is that if you go to 60% leverage, you have cost your shareholders 30% of the value of the share value, right? Just through leverage. Really matters, right? Shareholders are paying attention. Why are they paying attention? These shareholders are primarily institutional investors. They're very sophisticated investors, and they don't want these companies to have a lot of leverage, because when you have more than 50% leverage, it's easy to get into financial trouble, like the financial crisis showed us a few years ago. So low leverage creates value. Two more comments on leverage, which is that, two additional facts, is that in the financial crisis, only 2 REITs out of 120 equity REITs at the time failed. Right? So it's a failure rate of about 1.7%. Why did only 2? And the biggest one that failed was a company called GGP. They're a retail REIT. They just had a very unwise capital structure. They just had they own a lot. They continue to own a lot of the premier malls in the United States. They just simply had a stupid capital structure, and they got caught. They had to declare bankruptcy. But only 2 out of 120, right? With such a serious financial crisis, REIT share prices in the United States lost 60% of value. Right? So a big decline, yet only 2 companies went bankrupt. In comparison, 401 out of 5,800 banks in the United, commercial banks with assets more than $50 million, so 50 million, and I just excluded the really, really small banks, failed during the financial crisis. Right? A lot of people don't know that. Over 400 banks failed in the United States as a result of the financial crisis. Why did these banks? So it's a 6.9% failure rate, right? It's 4 times what REITs failed. Right? The rate of failure was 4 times what REITs did. Interestingly, why did these commercial banks fail? Well, first of all, they didn't fail because of subprime lending or purchasing mortgage-backed securities. A couple of people have written papers on this. They failed because they were making commercial real estate loans, and they were lending on residential construction projects to build houses. But there was a lot of commercial real estate also that they were lending on. Who were they lending to? Private borrowers. So they were lending to highly leveraged individuals, families, and they ended up losing the assets. They were foreclosed upon, and a lot of banks were doing a lot of this, and a number of these banks failed. Right? So that was commercial real estate, the lending to traditional private borrowers caused it. It wasn't the REITs. It was channeled towards the private guy. Again, I think it's, to me, this is good, strong evidence that, again, U.S. REITs are doing the right thing. Finally, on the supply side, I will argue that REITs have had a moderating effect on supply. Commercial real estate in the United States, it used to predictably boom and bust every 15 years or so, 10 or 15 years. Since REITs have sort of reached critical mass, which is around the early mid-1990s, there has been very little boom and bust. And the bust that happened you might say, well, what about the financial crisis? Well, the bust that was caused in the financial crisis in commercial real estate was caused by residential real estate to a large extent, right? It was residential real estate caught pneumonia and commercial real estate caught a cold because of it. It was not because of excessive development in commercial real estate. And in fact, what we've seen since the middle 1990s, there hasn't been 1 year in aggregate where the rate of development as a percentage of stock has exceeded 2.5%. And it's mostly been under 1.5%. And in recent years, it's been in the neighborhood of 1%, right? Extremely low rates of development. If you think about it, in the United States, population growth is about 0.8% per year on average. So just population growth merits 0.8% development rate to house activities for that extra population. And then it's estimated that commercial real estate obsolesces at a rate of about 1.5 to 2%. So if you add the 0.8% to 1.5 to 2%, just to replace the existing stock of space and to make room for immigrants, you need to be at the 2.5% mark. We're not there. We're not even close. It's really kind of a puzzle. It's an interesting puzzle, actually. And I think the answer is technology, information technology. The internet is making commercial real estate space less important. So I think that explains a lot of the gap. But I would argue that REITs have had a moderating effect as well on supply. And actually, I've studied it. I did a paper with some folks out of the Hong Kong office with BIS, which Yong Heng helped to make that happen. And what we show is that, well, if you look at the data around the world, but we were, again, largely focused on the US, but you see this in other countries as well, in terms of the boom, if commercial real estate prices are up, supply responds positively. That's what you'd expect. That's the boom part of it. But what we've seen since REITs have come on the scene, as REITs have gained market share, there's an offsetting effect. As commercial real estate prices increase, there's this goes up a lot, but there's an offsetting effect where REITs become bigger, they moderate the supply response on a downward basis. So instead of commercial real estate prices and supply doing this, what's happened is that REITs have caused the cycle not to do this, but to be more moderate. You still have a cycle, but it's much more moderate. What's going on? We argue that market players, market participants pay close attention to what's going on in the REIT market with share prices and so forth, the real-time information that's coming through and telling market participants things are going well, things are not going well. So for example, if a REIT, a multifamily REIT located in Atlanta, if there's been some recent multifamily development in Atlanta, and that REIT share price goes down, then some of the lenders, the smart lenders at least, will pay attention to that and maybe moderate their construction lending on commercial real estate and make it harder to develop, right? So that's the feedback that we think we're seeing. So again, I would argue that REITs have had a good effect on supply. All right, so I think I'm about out of time. So I'm going to wrap up. I've got 2 slides, conclusions and policy implications. I think I've just argued there's 3 red flags in commercial real estate markets: excess leverage, excess supply, and an aggressive bank lending. I would argue that REITs as stewards of capital get positive marks on all three counts. They allocate capital efficiently, they maintain low leverage, helping protect the financial system, and they've moderated supply, therefore boom and bust. So my conclusion is that, as you can tell, I'm sort of a fan of REITs, maybe more than sort of. But the story has been a good story so far, at least the U.S. REITs. So from a social perspective, to the extent that the U.S. model is replicable, REITs seem to deserve additional capital allocation to become larger. Finally, I want to end on circling back to my concerns on institutional. I think I've said it, but I'll say it again, just to end on a high note. Is that, well, what about institutional investment? Earlier I expressed some concerns. It's true that institutional investors don't use the same kind of leverage that the private investors do, generally speaking. That said, though, leverage has been increasing in the institutional investment world, and it's often hidden. Really, we're not sure how much leverage a lot of these investors have, these institutional investors really have out there. I think it's been increasing, but I just don't know. And I also know that at least in the U.S., a lot of pension funds channel money into private equity firms, where those private equity firms, as equity holders, right? So they're part owners of the company, and those private equity firms are highly leveraged themselves, right? So there's stuff going on the institutional side that we don't quite know what's going on, but to me it's concerning. It's also true that fund managers worry about liquidity. You think that, well, they're investing directly, is there really liquidity? But my concern is that what's happening is that, as you saw with the top 10 and top 20 cities, institutional investors focus a lot of money on those cities. And if you talk to them and you ask them why, they say, well, there's more liquidity in New York. If I need to get out and return money to my to the investors in the fund, if there's a call on that money, at least if I'm in New York, if I'm in London, if I'm in Hong Kong, I can sell. But I wonder how much of that's self-fulfilling. If everybody believes that, and there is a sudden shock and a deep shock, you're going to see a run on these funds. And if there's a run on these funds, just like there's a run on the bank, if there's a run on these funds, there's going to be a lot of pressure to sell all at the same time, which could create a lot of problems. So again, I think ultimately what's underlying this are the incentives to reach for yield, there's an increasingly vulnerable and fragile pension fund system, and again, not sovereign wealth. I know Singapore is a big player in sovereign wealth. I'm thinking a lot of this being concentrated in the U.S. But there's just a lot we don't know, and there's a lot of risks out there, I think. So when I think of the three ways to go in terms of holding commercial real estate, my bets are on REITs as the best place. So I'll stop there. Thank you very much.